Good afternoon, everyone. Thank you for joining our webinar today. I'm excited about today's webinar as we have Kezia Samuel from AssetMark, who will be providing a review of the markets from last year and insights on today's markets and opportunities and risks that AssetMark sees. Before I introduce Kezia, I want to give you an update on changes that Peter and I have gone through this year and last year, and some exciting things that we're looking forward to, as well as some housekeeping items for today's webinar. So Peter recently and I had recently transitioned to a new broker-dealer called USA Financial, and the move that we're very excited to have done will provide more investment options for clients, as well as lowering the overall costs for different options that are available. And so we're excited about the change and what it will mean for clients going forward. Another thing that wanted to mention is I've started writing articles for Kiplinger magazine starting this year. And so I am going to be sharing those articles through monthly emails that you will be receiving. So I hope you like the content, and if you would like me to write on certain topics, please let me know. But I always appreciate the feedback, and so if you have any feedback on certain topics or anything with regards to articles, all right, please let me know. This will always helpful for any articles I will be writing in the future. And lastly, wanted to let you know today's webinar is part of a series that we'll be doing this year on different topics. So I plan to do these every quarter, and being that's February, we'll probably do the next one in May. And so hopefully the information that will be provided will help you in understanding sort of what's going on in the world today, as well as help you in your personal situation as well. So for today's webinar, just one couple things for housekeeping. You've all been muted for the presentation, and if you need to ask a question, please do it in the chat box, which is located at the bottom of the Zoom screen. All questions will be answered at the end of the presentation during the Q&A session. And this webinar will be recorded, and a copy of the presentation and the webinar recording will be sent to you in the next couple of days. So I'm excited to introduce Kezia Samuel today. Kezia has over 20 years experience in the investment consulting industry. She previously held the role of Chief Portfolio Strategist at Global Financial Partners. She's currently the Vice President of Investment Consulting at AssetMark and has been with them since 2019. Kezia also holds a BS in Chemistry and Computer Science from Fordham University. She holds the Chartered Alternatives Investment Analyst and Chartered Financial Analyst designations. So it's my pleasure to introduce Kezia Samuel. Kezia, the floor is yours.
There I am. Hi, Mario. Thank you for having me join today. Good afternoon or good morning. You never know with these Zoom meetings where everyone is located, but hope everyone is having a wonderful start to 2024. You can see today's presentation, which I'll cover in the next 25 minutes or so. We'll walk through the world, but the title of today's presentation is New Year Quality Resolutions. Now, each year we kick things off and we make these resolutions, but the objective over the next 25 minutes is to arm you to understand the world and essentially try and find a way to cut through some of the noise that we see on a daily basis, such that you can make quality resolutions regarding your investment goals in the future. With that, Today's agenda will cover a quick look back on how 2023 performed as the markets, and then we will look forward because investing is about the future. And to understand that, we're going to look at two key topics. First is inflation. Where are we on this race to get to the Fed's 2% target? What is the current data points telling us? And then we'll hit on the next topic, which is on the economy. We've had this never-ending debate on a recession. Are we in one? Are we going to get one? What does the data again tell us? And last but not least, we'll end with some opportunities as well as risks that exist in the marketplace today. Let me start with 2023 as we look at the markets here. Before I dive into the numbers on the screen here, 2023 was the year Taylor Swift was named Person of the Year in Time magazine, but we also lost many dear individuals that had done quite a bit in their lifetimes, and one such individual is Charlie Munger. Now, Charlie Munger may not be a household name, but you probably know his business partner, Warren Buffett. Charlie Munger passed away in 2023, and he was full of quips and these sayings, and he was a personal mentor to me, not because I knew him, but someone I admired from a distance. And one of his sayings stood true to time, and that's it. That is that wealth is not built in the buying and the selling, but instead in the waiting. And if we think about what we experienced in 2023, relative to where we came from in 2022, had you not been patient and waited through that, you likely would have missed entirely the returns you see on the screen here. 2022 was a colossally bad year where stocks and bonds were both in the negative. In contrast, you can see in 2023, most investments had a banner year. Global equities up nearly 23%, a diversified portfolio of stocks and bonds, 16%. Real estate also up 11% on the hopes that interest rates potentially are headed lower sometime in 2024. Bonds up nearly 6%. The only thing with negative returns were commodities in 2023 as inflation started to weaken in comparison to where it was the year earlier, and there was also weakness coming from countries like China. Now, if you were to look at 2023, it is an exact mirror image of 2022. Everything that did well, such as commodities, did poorly in 2023. Again, a reminder that we should never use any single calendar year to make investment decisions and or make large adjustments. Now, within the global equity market, if you look at what's in there, the US stock market led the charge, followed by stocks in Europe was the second best performing, and the third best, while positive, lagged was stocks in emerging markets. But this US stock market, had this very unusual return. So what do I mean by that? Let's take a look at the 2023 returns, especially in the S&P 500. On the screen here, you're seeing that in the market for last year in 2023, we had 7 stocks. They've been coined the Magnificent Seven. What are these Magnificent Seven stocks? They include stocks like Apple, Amazon, Alphabet, Meta, which is essentially Facebook, Microsoft, NVIDIA, and Tesla. So these 7 stocks benefited from this new cutting-edge artificial intelligence technology that came to the forefront. The idea that, we no longer just have to type in the Google search machine. Instead, Google will think on our behalf. Things like ChatGPT came to the forefront. And so the markets got really excited about the potential for productivity improvements based on this artificial intelligence technology. And as such, it rewarded this very narrow group of stocks. You can see these 7 stocks were up 75%. In comparison, the broad S&P in the dark blue was up 22%, and then the balance 493 stocks were up 12%. Now that's a good number, but certainly paled in comparison to the remainder. Why do I share this, and why does this matter to you? I share this because you may personally be looking at your portfolio's returns and not necessarily seeing double strong 20, 25% returns. And that is unless you had these concentrated narrow group of stocks, your portfolio's returns could look drastically different. In fact, if you owned dividend paying stocks, not shown on the screen here, you may have even seen negative returns in comparison. So just something to keep in mind as we look at the market's returns, given how narrow it was, it may or may not be reflective of your particular returns for the year. The other thing that perhaps gets discussed even less is this chart here. Now, I call this if we were to X-ray your emotions after you get a bad quarterly statement, let's say, that's what we would be capturing in here. It's the echocardiogram of how we would feel, but transpose that to the stock market, which is the VIX, which measures the stock market's volatility in blue, and the bond market's volatility in green. Now, what you're seeing in here is something that is very unusual. As the Federal Reserve was trying to tame inflation and skyrocketed interest rates over the last 18 months or so, we have seen that the bond market's volatility, as you can see in the green line here, was 8 times higher than what you experienced in the stock market. In fact, the stock market looks benign in comparison. Historically, though, bonds are typically boring. They tend to do their own thing. They've never really made much sensation, let alone news, and historically tends to carry 5 times less volatility than stocks. So one of the things that we have seen is, yes, it's been a bit of a turbulent time for bond investors. However, as an investor, we know that the opportunities often tend to arise right when your stomach is churning. And in fact, with interest rates now sitting at a much better starting point than 0 2 years ago, the green line's elevated volatility tells me that what this means for all of us is that today, finally, savers are no longer being punished, but it has certainly taken a bit of a toll on how we got here. So that's a quick recap on 2023. But let's look ahead. And we're going to start with inflation. We just got an inflation reading today. In fact, the big picture inflation is at 3.1%. That means that from a year ago, prices across a wide variety of things that we purchase on a day-to-day basis is still rising, but rising at 3.1%. Now, when I say that, often it doesn't quite relate. So what we're going to do to understand what's next for inflation is we need to X-ray this. We're going to X-ray this into 3 key components in ways of how we spend our money. So what do we see on the screen here? We're looking at 3 lines here, 3 ways we spend our dollars. And the first is you're going to track the darkest blue line. You'll see that that is durable goods. And when I say durable goods, think things like washing machine or a car, things that have longer shelf life or durability. And you can see it's really skyrocketed in 21, early 2022. But since then, in fact, it has fallen below the 0 line. And I'm going to use an example. I don't know about any of you. Hopefully you were not looking for a car 2 years ago. But if you did, had you gone to the car lot, it would have said MSRP, but then you had to pay a premium above that. Today, that's no longer the case. As supply chain bottlenecks have been resolved, that washing machine or the car, the durable goods, in fact, are seeing their prices fall. So that's a good thing. That's helping inflation come down. But on the other hand, if you look at the blue line, this is non-durable. So think things like food, things that can perish and thus are not as durable as that washing machine that you may purchase. Now follow the blue line and take your light blue line and take your eye to the right-hand side. And you will see that after it fell, it started to go back again. And no surprise, if you've been to a grocery store recently, you come out and you're wondering, what exactly did I buy? Why are things so expensive? And that is because it is. What we're seeing is that things that are on the non-durable side, especially food items, haven't really seen their prices fall and sits above the pandemic levels. And so that pain point will likely continue to exist until we see a slowdown in the economy and the consumer demand weakens. But the third part is the one that is the most critical that we're watching very closely. That's the orange line called services. The third way we spend our money is by going out and experiencing services. So that's things like going to a restaurant. I'm going to use that as an example, or taking a vacation. But in a restaurant, there are two biggest expenses for that restaurant. It's going to be the people they employ, and it's also going to be the rent that they have to pay. And in each of these items, we see some potential pain points even as we come through the worst of inflation. And I'll talk a little bit more about that. But what this tells me when I look at this across the three different ways we spend money is that, yes, the worst of inflation is truly behind us. We don't think we're going back to 9% as we did last year, but the path to getting to the Federal Reserve's 2% inflation target is not going to be linear. It doesn't mean each month it's going to be a nice steady step downwards, and it's likely to be sticky. We expect inflation to come down closer to that 2% sometime later in this year, towards the end, if not early 2025. Why do we see this? And let's talk about those two components that I measured. Let's talk about wages, first of all. And what I'm showing you here is the national average of wages across the country, tracked by the Atlanta Fed. And you could see in the middle, if you take your eye, that big shot up in wages right in 2021, early 2022. That was the Great Resignation. This is when everyone decided to quit their jobs and demanded instantly that they pay double the wages. That's what you see on here. But since then, we have seen the wage that the average employee gets started to fall, but it's plateauing. It's going sideways at the very end. And here's a simple way to understand this. We have a very strong job market today. And as long as the job market remains strong, for those that have experienced a wage increase, it's hard to undo that wage increase unless you fire those employees. So as long as the job market remains strong, we think this component of inflation is likely to keep it higher for a little longer until we see broader weakness in the economy. On the other hand, what about those rents that we're paying? And I'm going to use, instead of looking at rent, which is really hard to sort of associate with something you and I would experience, we're going to look at home prices and anecdotally extend that same story. What we're seeing here is we've done a bit of an X-ray, similar to the way we did inflation. We've looked at home prices, but through the lens of if you are an existing home sales versus new home sales. Now, if you're lucky enough to own a home and or have refinanced your mortgage, those existing home sales, you can see in orange, fell as mortgage rates rose, but then just rose from there again. So we never really quite saw the drop in prices for existing home sales, certainly not to levels previously seen when mortgage rates doubled in such a short period of time. So existing home sale prices have stayed elevated. On the other hand, if you're a home builder and you built homes and they start building them about 18 months ago, and now they've come to the market, but mortgage rates have doubled, in order to move that inventory, they've needed to drop their prices. So you can see new home sale prices have actually fallen. Extrapolating the same into the rental equivalent, which is how inflation gets measured, existing leases are expensive, but we expect by the summer those existing leases to come due, and newer rental leases that have come to the market are much cheaper than those old existing ones. So we think in the summertime, we should start to see some relief flow through, thus helping inflation towards the end of the year. So something to keep in mind. Nonetheless, we think that the worst of inflation is truly behind us, but how we get to 2% is not going to be as smooth sailing as we want. Watch for this key component, which should show some relief towards the end of this year. Okay, so that's on inflation. Now, this is directly tied to what's happening in the economy, whether we get this recession Or do we get the soft landing, which is controlling inflation and keeping economic growth going? Can we do this combination? Let's see what the data tells us. I'm going to start with addressing, are we in a recession? This depends on where I am in the country. I often get, aren't we in one today? And a way to see this and state that we are unlikely to be in a recession is just, let's look at the unemployment rate. It's sitting at 3.7%, all the way on the far right, sitting near historic lows. And I don't know about you, but I have never seen a recession where we have added 2.3 million jobs in 2023. So we know the economy has been relatively strong and thus has kept the consumers, relatively continue to keep spending, thus driving economic growth. But this is backwards looking. This doesn't help us with what's coming our way. When I look ahead, we do see some softening or slowing in the economy after coming off a froth. So let's take a look at what does the job market look as we look ahead. And a way to see this is the number of open jobs. You can see on this chart on the far right-hand side, at the peak, there were 12 million open jobs. This was partly tied to the Great Resignation and the inability to find workers. But since then, you can see the number of open jobs has steadily declined, today sitting at roughly just shy of 9 million open jobs, but still remains a good job market. However, the days of I can quit and demand double the wages has also passed. So we are seeing weakness ahead in comparison to where we came from in regards to the number of open jobs. Now, the next thing that we're going to focus in on is on the consumer. In the US economy, in fact, 75% of US economic growth comes from all of us going out and spending and buying stuff. I tell my husband this is why I make that Friday night trip to Target to make the essential purchases to keep the economic engine in the US going. But in a way I kid, but let's take a look at the consumer, where they stand today in comparison to their ability where they were, let's say, a year and a half to 2 years ago. And I'm going to look at excess savings. When we look at the excess savings, first of all, what is excess savings? This is when you earn income and you net of paying your essential bills, what is left above and beyond. So not any savings that goes above and beyond. And you can see in the latter part of 2021 and early parts of 2022, across different income cohorts in the US, there was excess savings. We were stuck at home, couldn't really go spend that money, and we got that added stimulus. So excess savings rose. But take your eye now to the far right-hand side, and you will find that not only has the consumer depleted the excess savings, especially for the bottom 80% of income percentile, they've also, on the next slide, taken on credit card debt. So this tells me that the consumer is stretched. They're getting tapped out because they no longer have that reserve that was built up from the pandemic. I mentioned credit card debt, and we've heard anecdotes of the credit card balances now rising to $1 trillion+. In fact, though, if you multiply the average credit card by the interest charged on it, we know that credit card APR's interest rates are somewhere north of 23%. If you look at this trajectory, this tells me that not only is the consumer running out of excess savings, but they're also tapping in on the credit card, thus being stretched to begin with as the cost of higher goods is taking a toll. Now, when I show this chart here, consumers are always concerned, is this a repeat of 2007, so that if we do potentially see an economic slowdown, is it going to be really bad? And there's some good news. When we look at the total household debt, in the light blue, we look at the total. In the orange, consumers, so things, auto loans, etc. And then the darkest blue line is the mortgage. Now, when we look through this, you will find that on the far right-hand side, the total amount of household debt sits well below, right in the middle, in that 2007. So we're nothing in comparison to where we were in 2007. The average consumer's total debt still remains manageable. Why? Because the biggest debt the consumer has on their balance sheet is their homes. And if you were lucky enough to, again, purchase a home, then we know that it's been likely refied given the decade of zero interest rates that we came through. We also know that there's less than 30% of outstanding mortgages are above 4%. So we do know that the consumer has benefited, and we just don't see a big, bad 2007-like scenario laying ahead, even if we see the broader economy slowing in comparison to what we've come from. While the US consumer is slowing down, we are seeing governments continue to spend. Now we're seeing a variety of different programs that were put in place that were multi-year plans. So things like IRA, the Inflation Reduction Act, as well as the CHIPS Act, which brings back the manufacturing of the chips that are used in everything from washing machines to phones. We're bringing back that manufacturing to the local US shores. All of that has essentially created this spending is helping while the consumer is slowing down, the government support is helping the economy stay afloat. So we see a bit of a seesaw effect taking place across the two, one slowing down while the other is continuing to support the economic slowdown that's likely headed our way. Now, when I show this chart, often it raises the question of what about our debt? Shouldn't we be concerned about it? Now, certainly our debt and our deficit sits at a level that is likely something we need to watch for. But does it mean imminent doom? And here's where the answer is not as simple as we may think. In the green shaded area, we're showing you US GDP. So this is the US economic scorecard by quarter, measured all the way back from 1960s. And in the black line, we measure the interest that we have to pay on our debt as a percentage of the total economy. Why do we look at it this way? Think of it in the same way. If you applied for a mortgage, they're going to look to see what percent of each monthly paycheck is your debt that you're going to have to pay. So your debt to income ratio is the same way we're going to apply from the consumer for the country. I want you to look on the far right-hand side. Clearly, we have taken that line and it's gone up as interest rates have gone up and our debt has gone up. But look back into the 90s. In the 90s, we had a similar scenario. Well, the total percent of our interest expense was at the same size as it is today, even though the total debt back in the 90s was not as big. So there's two ways to resolve this. One is to grow the economy faster so that we can reap revenues to pay for some of this expense that we have taken on. And second is to cut back on the spending and/or a combination of the two. But you can see back in the 90s, when we hit that same level as we are today, we did have a strong decade. It did not necessarily mean that the economy or the stock market just fell over. Instead, the lens that the stock market is applying is, can we grow the economy to pay for the expenses we've taken on? And so far, in the near term, it's not necessarily concerning, but certainly something that we need to keep a watchful eye on and address in the intermediate to longer term. So that's the outlook on the economy. Yes, we have seen a robust economy. We are slowing down. Whether we will get a recession is not necessarily guaranteed. Whether we will guaranteed get a soft landing is not the case either. We see a bit of a mixed bag, and we will wait to see greater data before we proceed to make a call in either direction. But right now, the economy certainly is on a strong hold. All right, I'm going to end with some opportunities and risks. Let me start with one, which is if you took 2022, as I stated earlier, it was a bad year, and you moved to the cash as a way to wait it out. One of the things that we have seen is many cash investors went into a CD that paid 5%, looked great, but there are opportunity costs that come with making that decision. And so here we're showing you what happens to cash investments after the Fed is done raising interest rates. And we know we're sitting in a position, in fact, the Fed has told us, while they're not going to immediately cut interest rates, they're also done raising interest rates because they're waiting to see the impact of the higher interest rates on the economy before they make a decision going forward. And so on this bar chart here, we look in the light blue, what happens to cash on the far left-hand side in comparison to stocks, bonds, and a diversified stock bond portfolio in light blue 1 year after, and in dark blue 5 years after. You'll notice cash tends to trail in the light blue in comparison to stocks and bonds. They tend to trail. Now, first of all, we're not comparing cash with stocks and bonds. They're not the same. If you have near-term needs, cash is one of the best solutions given the liquidity that it provides. However, if this is excess cash, then it does come with that opportunity cost. So why do stocks and bonds tend to do better? Now, bonds will do better because as a bond investor, if I bought that 5% bond and interest rates fall to, let's say, 4%, my 5% bond is more valuable. So the bond price starts to rise. In comparison, looking at cash, the 5% CD, which was a 1 year CD, when it comes to mature, you're going to get the current interest rates. And if it is 4%, you're going to reinvest at 4%. So likely seeing a loss of potential opportunity if the Fed is done raising interest rates. Bonds appreciate whilst cash does not. What about stocks? In simple terms, if the cost of doing business falls as interest rates fall, stocks also tends to benefit. So for a longer term opportunity, longer term horizon, those investments tends to do better once the Fed is done raising interest rates historically, just something to keep in mind. Now, another theme that we are very excited about, investing is not about every calendar year, but what's likely to change our future. And here we're showing you, when we talked about the Magnificent Seven and artificial intelligence, here's a look into what we can expect ahead as its impact comes forward. So this is the personal computers. I don't know about you, Mario, if we were lucky enough to have a giant computer, in fact, the monitor and the keyboard were all big one thing. This is the impact on productivity growth on a 5-year basis from the introduction of personal computers. The next was the internet. I don't know about you, but I cannot imagine life without the internet today. We expect artificial intelligence to have a similar impact on the improvements to productivity, thus driving future economic growth. We're still in the infancy stages to even understand the impact. There will be some good and there are likely to be some negative consequences, but we remain at the exciting precipice of change. Now, with all excitements, we always have to sort of look at the impact of the risk that we're having. And one of the side effects is, as we looked at those 7 stocks skyrocket in prices, it has had an impact on your investments, whether or not you may be aware. As an example, the S&P 500, while it's got 500 stocks in it, they're not all created equal. The larger stocks whose prices appreciate faster, they have a bigger weight in the index. So you can see on the left-hand side chart in pink, these 7 companies make up nearly 30% of the S&P 500 index. Now, that's not necessarily concerning immediately, but perhaps for many clients that may not have been obvious that 7 stocks made up nearly a third of your portfolio, because not all stocks carry an equal weight. In fact, they're so big that these 7 stocks are bigger than all stocks put together in Japan, France, China, and the United Kingdom. That's how large these stocks are. Why do I highlight this? First, to be aware of the complexity that when you look at an index, it may not be as one would imagine. And the second is when these shiny objects come to the forefront, and we talk a lot about them, often it's at the cost of not knowing what else could be cheaper and available in the marketplace. It's the equivalent of if you've ever gone to a store, and when you know where the sale rack is, it's never in the front of the store. It's always in the back. You've got to walk through the store to get past the new shiny objects to find those things that are on sale. And today we think that the market has not necessarily appreciated equally, thus some classic companies that are available at more reasonable rates than compared to, let's say, these 7 companies that are shown on here. And the last thing I'll highlight here, this is my last slide before we can open it up for Q&A. Rarely do I get to use the word guaranteed. but 2024 is an election year and we're guaranteed to get some volatility. Why? Because we are likely to see headlines that are sensationalized and polarized, trying to pull on our emotional strengths. However, mixing politics and investing historically has never been a great strategy, at least not so consistently. How do I see this? On this slide here, we look at the S&P 500 all the way back to 1947 across different government controls. In full red when the Senate, House, and the presidency is under Republican control. In blue when the Senate, House, and presidency is under Democratic control. And then in gray when it's mixed. First, note that the majority of the time, the government control is split. Now, maybe the markets tend to like this because maybe it's a do no harm or do nothing. I don't know which side of the camp investors fall under. But on average, that has happened 60% of the time, and the markets have generated an average return of 8%. 8% for many investors is likely a very strong return. And what this tells me is that, yes, we as humans see the markets, the politics lens through red and blue, but markets only see shades of gray. Ford is not going to stop making cars because there's a presidential election year. Kimberly-Clark is not going to stop making toilet paper because there's an election year. Just remember that companies are prepared for this. And it is important that we do not mix politics and investing to derail whatever may be our long-term goals. With that, I'm going to stop sharing. Hopefully I've made sense and see if there's any questions.
Excellent presentation, Kezia. Thank you so much for that. There were some questions that were sent in previously, but to the audience, if you have a question, please put that in the chat box and I'll go ahead and read that off to Kezia and she can answer it. But in the meantime, until people can put questions in, I have a couple of questions here that came in. One was on inflation, and so you talked about inflation and that it could be sticky for the year, during the year. But what is your take on where inflation will end up at the end of this year?
High twos is
Okay.
so not exactly twos, but high twos is where we expect inflation to fall somewhere towards the year. And remember, the Fed is not targeting exactly 2. They're looking at an average of 2 over a period of time. So as long as they see the trend is headed in that direction, then they're likely to take their foot off the interest rate gas pedal, which is what they've done right now. But they're not going to cut interest rates until they see a clearer prediction towards that number. So we're still sitting at 3. We need to start seeing it in the high 2s before the Fed would likely feel comfortable to cut interest rates. So somewhere in the high 2s is where we see inflation towards the end of the year.
Okay. So having said that, how many times do you think that to get to that 2% inflation rate, do you think that the Federal Reserve will be able to decrease rates based on 3 times what they mentioned, they signaled last year, or do you think there will be more? What is your feeling on that?
I'm going to use 2022 as an example, 2023 as an example. The Fed thought that they could stop at somewhere in the 4s and had to go to the 5s. And the markets thought they would be done at the 5s, then went to 6s, then came back. First, the point that I'm trying to highlight is it is entirely going to be data dependent. If we have a strong economy and the consumer does not take off their foot off the spending gas pedal, expect them to take longer before they start cutting interest rates, right? So it's all going to be data dependent. Today, there is a disconnect. The Fed has told us maybe they start cutting interest rates by June, July. The markets initially, the start of the year, anticipated it was going to be in March, then has realized maybe not March, maybe April, now May. And so the market is anticipating rate cuts sooner than what the Fed is telling us. But the Fed is likely going to be data dependent because we have seen them change their paths based on how the data presents itself.
Okay. So a question just came in here. So the question is, do you have any thoughts on today's market hiccup and the inflation report that triggered the drop relative to your overall analysis?
Yeah, this is
based on
quite
what you
normal.
presented today?
Yeah. So just as we stated, if you look at today's inflation data reading, the reason it has stayed above 3%, market was expecting 2.9, it came in at 3.1. And one of the key drivers has been the rental component. Why? Because as I stated, majority of them are likely to come due in the summer, and that's when we start to see some of the fall in inflation. The reason the markets are throwing a bit of a tizzy fit is because we have nearly priced ourselves to perfection. And if interest rates don't come as soon as they had anticipated, some of that price gain needs to be undone. We don't see this as a potential, here comes the big fall, but these are the natural oscillations, to say, of how the markets behave. If they get a little ahead of themselves, and they may have to undo some of that exuberance or enthusiasm to right size the price to what the expectation should be. So some of this was very much anticipated in the sense that no market goes up in a straight line. And when it needs to autocorrect, these things happen. This is well within the norm.
Okay. So there's been much press in the last year regarding commercial loans and the potential for those commercial loans coming due to have to be repriced and new loans having to be taken out at higher rates.
Yeah.
What is your feeling on the impact this will have on regional banks this year? And do you think that that could potentially mean that the Federal Reserve may have to lower rates earlier than what they anticipate?
I'm going to break this question up into two parts. The first is, what is a commercial real estate? Do we see, is there another leg to drop? We saw a bit of a preview of this in April of last year, which is when the Federal Reserve stepped in to provide liquidity to those regional banks exposed to commercial loans so that they could essentially sort of navigate and ride this higher interest rate environment. Are we likely to see some more? Potentially. We saw a bank, in fact, surface in New York, making headlines again. Are there others? Potentially as well. However, we don't see it's important we don't equate this to 2008, which had a similar feeling to it, with a banking-led crisis. Now, when commercial real estate loans are often made by local regional banks. They're not necessarily going to the big banks. So the exposure of commercial real estate to larger banks is much smaller than the 2008 scenario, which was so widespread and truly global in nature. So while, yes, I don't think it's fully done yet, it's much more contained than 2008's like scenarios. That's part one. What's the impact on the broader economy? The question that investors should ask is, what's not been priced into the markets? We have seen commercial real estate prices decimated. The question is there something additional that the markets are not aware of, such that it could create further, further ripple effects? And today we still see this as a somewhat contained, it doesn't mean it's a good thing, but somewhat contained scenario, which is why you're seeing the markets relatively benign post the April scenario of 2023. So that's where we see on the commercial real estate side of things. Now, as it relates to, does this really slow the economy down in regards to big maturities coming due? The big wall we're watching for is 2025, where we do see significant refinancing opportunities for these commercial loans coming due at much higher rates. Mm-hmm. Will that mean that some additional portion is going to struggle? Possibly. Mm-hmm. But again, the investor should always ask, the market has already priced this in. The question is, are there more than what has already been priced in? And that today to us is not necessarily an obvious, yes, the entire thing is going to crater, but yes, I think this market will likely struggle, not just now, will likely continue to struggle until they see a stronger footing. I think you had asked a question and I forgot, what will the Fed do?
Yeah, right.
If this has a ripple effect into the broader economy and the economy starts to tilt over to the point of the soft landing, which is inflation is controlled and the economy is strong, that scenario doesn't play out, then you will see faster rate cuts. Clearly, you saw them do it in April of last year when they stepped in and they gave these banks a liquidity line. You'll likely see them come in and do this to the broader economy if it takes that big a toll. They've said the intention is not to only curb inflation at the cost of causing decimation. It's to balance inflation and the economy. Not an easy task, but yes, expect them to cut rates should that equation tilt one way or the other.
Okay, great. Okay. Okay, doesn't look like we have any more questions. So thank you again, Kezia, for a wonderful presentation. Thanks, and that was excellent. If anybody has any additional questions, certainly email me. And like I mentioned before, a copy of the presentation today, Kezia's presentation today, will be sent to you as well as the recording. So thank you again all for participating in today's webinar, and have a nice evening. Thank you again. Bye-bye.
Take care. Bye.